There he comes. There's the man himself. How are you, Rick?
I'm fine, Albert. Thank you. How are you?
I'm great. Good to see you again. You've been busy guy lately.
It has been, in particular, a busy day. So I'm delighted to be with you, though. Thank you for arranging this.
Yeah, no problem. We got a few questions to get through here today, Rick, and also a few questions of my own. But before we do that, I don't know if we have a stream scheduled for next week. So I want to remind everyone that we got the Royalty and Streaming Bootcamp coming up Saturday, October 21st. I'm really excited, Rick. I had a pre-event meeting with Doug Silver, and I'm just really stoked. He has a great talk planned. I saw the outline. It's just going to be outstanding. Your thoughts on Doug and also the event and the sponsors we have lined up?
Well, I think the most important thing to note is that we had to postpone the event pending Doug's ability to participate. I've known Doug Silver for 3 decades. And when I first met Doug 30 years ago, what struck me is that he had a database that he had built and maintained himself of 4,000 private royalties in the mining business, meaning that 3 decades ago, he was the ranking expert in the world in mineral royalties. And his ability to describe for us the structure of a royalty market that he helped create, I think absolutely guarantees that this boot camp is going to be well worth investors' while. And I think it's fair to say, Albert, that this continues our tradition of having absolutely spectacular keynote speakers give overviews of the industry. I'm reminded of Per's overview at the Uranium boot camp and the electric and battery metals boot camp. And I suspect that Doug Silver's opening address will be worth the price of admission all by itself. But of course, we're going to give people much, much, much more. I know I sound like a commercial, Albert, but I'm particularly excited about this because I believe that the royalty and streaming business is the best business in the mining or oil and gas investment business. And I think a case can be made that many investors could build natural resource portfolios in oil and gas and mining simply out of royalty and streaming companies, and probably achieve at least most of the beta with much less work and also much less risk than they would constructing a more broadly representative portfolio.
Yeah, Rick, and we have Battle Bank returning as the executive sponsor for this event. I did a pre-event interview with Frank Trotter. If anyone hasn't seen it yet, it's going to be coming soon. We're going to send it out with the announcement. But they're still getting lots of questions about people interested in these products, particularly the gold lending program, Rick. And then you have some exciting sort of solo 401k, small business type stuff. I imagine people will be very interested in that. I expect to get a lot of questions at the event.
Well, I hope that's right. As you know, I'm ostensibly retired, and starting a bank isn't necessarily something that I would recommend to people who are interested in retirement. But the idea that we can serve hundreds of thousands of people better, much as this management team did with Everbank, is extremely exciting. The products that you talk about, the ability for people who hold physical precious metals like I do to access liquidity and credit using those metals as a collateral is good both for the borrower and, of course, for the institution. And we will maintain the tradition started by Everbank of offering simple, high-yield savings products. But unlike most banks, we'll do that in multiple currencies, which I think will do well. As you alluded to, we have learned, too, that we can make your IRA, meaning that rather than just having it as a repository for financial products originated by great big financial services concerns, with an Battle Bank IRA, you'll be able to own a single family rental residential, a duplex, a triplex, a fourplex, in some circumstances, a private owner operated business. In other words, we're able to make your IRA truly your IRA, which I'm really looking forward to doing.
Yeah. And surprisingly, completely legit by IRS standards. So even better. And Rick, I can't move on without mentioning the sponsors we have. This is a short list handpicked by you. And, similar to the Rules Symposium, the annual in-person event in July, sponsors are part of the program here. They bring valuable content and information and education to the attendees. So we got 4 good ones here. Wondering if you could talk briefly about this group, maybe just as a whole. Empress Royalty, Elemental, Altus Royalties, Orogen, and Gold Royalty. That rounds out the 4 sponsors, Rick.
Well, I think the first thing that I need to say is I own them all. Every sponsored event put on by Rural Investment Media, be it the boot camps or be it our live seminars, feature exhibitors who aren't merely advertisers, but rather exhibitors who we own. There's no guarantee, unfortunately, that because we own stocks, they go up, but there is a guarantee that we have vetted them well enough that we own them ourselves. Our attendees, Albert, have told me for almost 3 decades that they consider the exhibitors to be content too. And the consequence of that is, as I say, that we vet our exhibitors much more carefully than you would find in other virtual or live investment symposiums.
Okay, and so finally, that's going to be October 21st. Rulesymposium.com/bootcamp is where you find out about it. And if you buy a ticket, you have online access, unlimited, through Rule Classroom to the archive. And even if you can't make the event, strongly recommend you register ahead of time to save 50% on your registration. All right, Rick, thank you for that intro. I want to get to some questions here. We had a couple that came in while you were gone. And this one's interesting. This is from Jean, and she wants you to comment on the uranium price of late. And, you know, we've had some ups and downs, but overall this year it's been up. It's been steadily increasing. You know, lately there's been a bump, Rick. What do you attribute that to? And what do you expect going forward?
Well, obviously, uranium is one of the few commodities that has continued to enjoy a bull market, and a bull market really that has been increasing. Those people who attended our uranium boot camp will know the reasons for this bull market. We don't have time to go into all of them here, except to say simply sort of supply and demand. We had anticipated that the timing of this bull market would be contingent on the pace of Japanese restarts. The restart of the Japanese nuclear fleet has begun in earnest, and as we had expected, that has led to a dramatic tightening in the uranium price. It's important to note, too, Albert, that there are at least 2 prices in the uranium business. The spot price, which is widely followed, which is the cash market transaction price for uranium today. But more importantly, the term market. The term market is much more opaque. It's contractual, and it covers relationships between buyers and sellers in uranium that might be 5 or 10 years in duration. This is important, both because it's opaque, which means it's hard to see, but also because there's price stability, both for the user and for the producer of uranium. If you are a uranium mining company and you have price certainty, both with regards to price and volume, over, say, a 10-year term, with a credit-rated, an investment-rated counterparty, let's say a big U.S. utility as an example, you can take that deposit and that contract to the bank and raise development and construction finance. So for the senior producers, entering into long-term contracts gives them the certainty with regards to pricing that will enable them to almost guarantee a reasonable return on capital employed after financing costs. It's the new tightness, the firmness in the term market, I think, that's really beginning to drive the market in uranium equities. Much, by the way, yes, I want to pat ourselves on the shoulder, much as we suggested, exactly, in fact, as we suggested would happen in the uranium boot camp.
Right. And that boot camp was what, a year and a half or longer ago? It just shows you have to be patient with this stuff, right? These are themes that play out over several years, sometimes, or longer.
That's a very important point, Albert. You know, the first wonder of the financing world is compounding, and compounding takes time. If there are several circumstances that you think over time will inure to the benefit of a commodity, you have to allow that to occur. Everything that we talk about, be it royalty and streaming, be it uranium, be it silver, all requires time. We teach in the Rule classroom the difference between the phrase inevitable and imminent. Inevitable meaning it has to happen, imminent meaning it doesn't necessarily have to happen now. But we teach too, Albert, the primacy of asking questions where the answer begins with when, not if. Investing or speculating in things where the probability is solidly on our favor. And one of the things that constrains the rest of the competitors in the investment landscape is a sense of timing.
Yeah, and even before the uranium boot camp, this was evident to you. You've been talking about it for a while. I've known Amir and Scott so long. I feel like we almost went to high school together. It's been a long time. And think about how many times the market has given you an opportunity to give up on this thesis, Rick. Yet if you stuck through, you can see things coming together quite nicely for you.
Albert, that's why the Rule classroom is so important. If you have knowledge, if you have training, if you can establish a sense of the value in your investment, you are able to hold it through the ups and downs. The people who aren't willing to stomach the declines are the people who don't know enough about why they made the investment to begin with. Those people are cautious for a reason. That reason is their own ignorance. To the extent that we are able to teach people the probabilities around investing and speculating, those people will be better able to withstand both the volatility that they have to endure in markets and the time that is required to allow these investments and speculations to mature.
Okay, let's see. Question from Cohen. This is a long one, so I'm just going to read it, Rick. It says, for developers, this is from September 20th, by the way, so it's a little old, but I still want to ask it. For developers listed in Canada, it's easy to find the recommendations and, quote, unanswered questions, unquote, at the end of each technical report in the last chapter. However, in Australia, there is no legal obligation for developers to publish the complete technical report on their website or on the ASX exchange. They usually publish a much shorter summary version. Sadly enough, they do not publish the recommendations from the engineering firm, so there's no way of knowing what they are. I wonder, how does Rick deal with this?
That's a great question. One of the things that I prefer to do is contact the companies directly, irrespective, frankly, of their domicile, which is to say, after I've suffered through the Canadian document, the 43-101, the feasibility study, the pre-feasibility study, I always try to get a telephonic annotated version from the company itself. Many people believe that only folks like me have access to a company, which is wrong. What you'll find is that a well-run company is run by people who are so passionate about what they do that they're delighted to talk about their company. And you can ask them very, very, very pointed questions. The nature of the response tells you an awful lot about whether or not you should invest in the company. If you are, as an example, talking to the head of exploration about the methods to be used in exploration or the unanswered questions, or if you are asking him or her to take you through the significance of some portion of a press release and they are unable or unwilling to do so, that tells you a lot about the nature of their commitment to the company or their confidence in the company. If, by contrast, as usually happens with a responsible issuer with committed management team, if you can't get them off the phone, if they're so passionate about what they're doing that they're making you late for lunch or dinner, you have a sense that you're on to a pretty good thing. As I say, I have found that it's worth my while, even with very complete documentation, to review that documentation with the company itself. There is nuance in a study. There is nuance in a press release that doesn't immediately jump off the page to any questioner. And it's very useful to have somebody in the company give you what I would describe as an annotated description of the document. That includes Australian companies. I've been investing and speculating in Australian companies for 4 decades. I've enjoyed real success, and I have particularly enjoyed people, as an example, like John Borshoff, or like the folks now behind Emerald Resources, who I've invested with for many years, who will take me literally by the hand through the data, which would otherwise be very dry and difficult to understand.
Okay, that's excellent. In general, that I've been impressed with, especially the companies we deal with, their willingness to speak with investors. But I think the willingness to miss lunch has something to do with the size of the fish they're trying to reel in, Rick.
Maybe they look at me, Albert, and say, I need to miss lunch.
Question via the classroom from Zach. Zach asked, for those as an alpha speculator investor who dive deep in research into companies' reports and statements, what are some key points to look for during the readings?
I think the obvious to begin with, I am interested as an alpha speculator in the size of the prize. Too often, companies look for small mines. The risk is that they might find one. A small mine has all the risk attendant of a big mine, but can only ever make you small money. So the first thing that I'm really interested in is the size of the prize. We've gone over this, of course, in the real classroom. The second thing is I want the expertise of the management team to be specifically related to the task at hand. In other words, it isn't enough to me that these people have been successful in the past. I want them to have been successful in a way that relates directly to the job that they're doing now. I want a real sense from the company, Albert, and I want this sense repeated, if possible, in public utterances as to what it is precisely that they're trying to accomplish at any given point in time. You'll remember the discussions that you and I have had about answering unanswered questions. Many alpha companies don't really understand the process of delivering value. They don't understand the importance of the methodical answering of unanswered questions. If they don't understand the path forward, I don't have any particular use to investing with them. I want companies that have been unsuccessful to at least tacitly acknowledge that their previous path was incorrect, and to talk about how the data that they've gathered so far has led them to a new interpretation. And I want to understand and I want to agree with it. Too often, a company embarks on, say, a $10 million exploration program, which ends when they've spent $10 million. Often their thesis has been completely disproven with $3 million. And rather than waste the last 7, it would be useful if they had used the data that they had gathered to date to refine their technique or save it for another project.
Yeah. Speaking of course corrections, Rick, it reminds me of the beginning of Franco-Nevada, the quote attributed to Pierre Lassonde that drilling holes without any geological expertise is the quickest way to the poorhouse. They did a very drastic course correction in their business plan, and it worked out. I mean, it's monumental what they were able to achieve. Let's see. I got a question from Victor. Victor's asking, is there a discussion board or forum within the classroom where members can discuss stocks and questions with Rick? In the classroom, I would suggest you put those in the news section if there's an article that you want to reference, post it together. Include a hashtag with the stock ticker and then tag Rick as well. And what will happen is, for a while, I'll be manually sending those to Rick and getting you the answers. Eventually, over time, Rick is going to be on the platform answering those questions directly as he does in other forums. So I look forward to that happening soon.
Perhaps, Albert, we should consider having a Rule Classroom session like this after the Royalty and Streaming Bootcamp, where we answer the questions that have been brought up as a consequence of the course material. That might be very useful for people. Absolutely.
And we often bring back the most heavily requested sponsor, as we did with Benoit LaSalle last time. Happy to bring back a CEO if people found that the presentation was particularly compelling. Okay, so back to the classroom. Eric asks, this is not a fun question to entertain. If there is an attack on a U.S. embassy, what response will we likely see in the physical silver and mining stocks? I think it depends on who the presumed attacker is, for one thing. Rick, beyond that, what are your thoughts on that? Some kind of...
I need to begin by saying that's above my pay grade. I'm reasonably competent, I think, at analyzing financial statements and geological or technical information, and much less competent as a commentator on world events. I would suggest that the near-term impact of an attack on a U.S. embassy would probably be difficult for all financial markets, mining stocks notwithstanding. There might be an increase in the general level of fear, which is often good in the very near term for gold and silver stocks. But in my experience, the type of fear around geopolitics has never, or at least seldom, led to a meaningful increase in precious metals prices. Precious metals prices seem to increase when people have fear concerning the maintenance of purchasing power in fiat-denominated savings products. So my suspicion is that any reaction in the market would be fairly short-term, with the caveat that I'm talking about something that I'm not really expert in.
Paul says that he's interested in feedback on commodities in light of heightened tensions. And I think, it's pretty much impossible to escape this reality, I guess, if you're a commodity investor, wouldn't you say? It's a global market, there's geopolitics, there's, military conflict. This is always going to come up, right?
I think the most dramatic impact that we could consider as a strong possibility or a probability in light of the events in the Middle East would be that if there was a perception of a disruption in oil and gas shipments from the Middle East, from Kuwait, from Saudi, from the UAE, from Iran, if there were tensions in the Strait of Hormuz, or if there was a resumption of something resembling the Arab oil embargo as a protest to U.S. involvement with Israel, that would have a real dramatic impact on energy prices. I'm not anticipating that happens, but again, my disclaimer: I'm not an expert on geopolitics. If the United States was to use that aircraft carrier that they seem to be sending in that direction, then I think all bets are off.
Bernard asks regarding the royalty boot camp, why don't we have an oil and gas royalty companies? Why don't we have oil and gas companies at the boot camp? I think it's something we'd like to do in the future and have the appropriate experts present as well to shed light on it. Rick, this is a very popular topic, Rick. We decided to go with the mining folks this time. These are the people we know very well. But in the future, Rick, what about a oil and gas boot camp?
I would love to do it. I need a Doug Silver. I need somebody who comes from the oil and gas business who can explain both volumetric production payments, which is what oil and gas guys call streaming, and the royalty side of the business. The streaming side of the oil and gas business is much larger than the streaming side of the mining business. It just goes by a different name, and it's carried out differently. And the royalty business has been around in the oil and gas much longer than it's been in the mining business. What I need is this keynote speaker, this Doug Silver type from the oil and gas business to kick it off. Once I did that, once I was able to say that Albert Liu and Rick Rule had presented an 8.5 or 9 hour boot camp that was the best that it could be, then we can push the button and do it.
Yeah, no, I agree. It's something that we aspire to do, though. Patrick asks, where can I learn about strategic asset allocations? Thanks and greetings from Switzerland. Rick, your thoughts personally on asset allocation?
I don't do it. In a very broad sense, I try to invest in things I understand when they're out of favor. I have invested in areas outside my area of expertise because I thought they were high quality areas, but I've always done it in a way that emphasized beta allocations rather than alpha allocations. As an example, in terms of general market securities, those that have been outside of the insurance and banking business, which I understood, I have mostly confined to buying an ETF called the Dividend Aristocrats, which are very high quality companies that dominate their sector and have paid increasing or stable dividends for 30 or more years, or Berkshire Hathaway. I tend not to be a thematic investor particularly. I regard the stock market, as an example, as a facility to buy and sell fractional shares or fractional ownership of businesses rather than as a subject itself. I view it as a facility. So I'm probably the wrong person to talk to about tactical asset allocation because I don't do it.
Okay, let's go back to uranium with Gene. The question is, I guess your comments on instances when sort of the physical commodity gets decoupled from the equities. And so the equities, so the physical outperforms because the equities end up discounting a lower price than spot, effectively discounting a uranium price declining in future years. It kind of reminds me of like an inverted yield curve in the bond market, Rick. What are your thoughts on that?
That's a very good question. And I'm going to answer it as best I can, with the caveat that I'm not necessarily an expert on markets, but more an expert on companies. What seems to happen in commodity bull markets is that the bull market is led by the commodity itself, which is to say the recovery in any integrated commodity market is usually led by the commodity itself. After the commodity moves, the biggest, highest quality, lowest cost, most liquid producers move next. After that trend has been established, the second tier producers move. Then the developers move. Then the explorers move. Think of a circus master's whip. The market is the whip. The commodity is the front of the whip. It moves first, but it doesn't move the furthest. As you go out the quality chain, the move occurs later, but the move is itself more dramatic. So the questioner's observation, which is to say that commodities and equities uncouple, is particularly true, at least to the upside, in the beginnings of a bull market. You saw, as an example, in the beginning of this year, the market for physical uranium rally from sort of $40 to $55 before the uranium equities, other than Cameco, saw any sign of life at all. You saw the next move in the market take place, of course, with Cameco, the institutional quality name. Now you're starting to see the rest of the market follow pace. So the observation of the questioner is accurate, at least at the beginning of a bull market.
One of the things that came up in my discussion with Doug Silver was he has a slogan. He says a dollar is a dollar, but at the same time, he acknowledges that there's a premium on gold royalties over the other types of royalty companies. You want to speak to that, Rick, and why it's so, and maybe why Doug is remaining stubborn on that issue? What do you think is going on there?
A dollar is a dollar, and I'm happy to make money in sand and gravel or natural gas or uranium or gold. I'm agnostic as to the source of my income. I will say that the market pays more for oil and gas, for precious metals free cash flow. And what that means as a long-term investor is that your cost of capital is often lower. If you can buy, as an example, gold royalty companies when they're out of favor, and you can benefit from their increasingly lower cost of capital as they come back into favor, you hit the trifecta. You get the dollar, but your cost of acquiring the dollar in the context of your cost of capital in public markets is less.
Right. Okay, I got a question from Dwayne. It looks familiar. I'm not sure if I've asked you this one before, but my notes don't reflect that, so I'll ask anyway. This is about royalty streaming companies, and let's talk about the factors that would give one royalty streaming entity a competitive advantage over others. What things do you look for, Rick?
There are at least two. The quality of the existing asset. What you find is that big mines make big money, and big mines yield surprises that are positive. Small mines have big risks, they make you small money, and the surprises are almost always negative. So royalties on great big multi-decade mines turn out to be always worth substantially more than their indicated net present value at the time that you look at them. The classic example, of course, of this would be Franco-Nevada's acquisition of the Goldstrike royalty in 1982 for $2 million, if my memory serves me well. That royalty, with a $2 million acquisition cost, has generated over $1 billion in payments and continues to increase in production 40 years later. If you contrast that with a royalty on a 500,000 ounce deposit that's been fairly well, drilled off, where your only surprise is likely to be internal dilution, you'll understand that the prize is the first thing. But the second thing is the recycle ratio. The recycle ratio is an oil and gas industry phrase that talks about the ability of a management team to reallocate the capital received from royalty payments in new investments that can maintain the income stream over time. Again, Franco-Nevada has been very successful at reinvesting the free cash flow from existing royalties in new income-generating opportunities, as has, of course, their major competitor, Silver Wheaton. So I think those two things, the quality of the assets and the ability, as measured by time, of the management team to allocate the capital returned from those investments in new opportunity.
Rick, we had a lengthy discussion on this as part of the intro to natural resource investing, and I believe the example you used was Freeport. Does that sound right? Or was there another example you used?
No, I used the Freeport oil and gas business. Part of the Freeport-McMoRan enterprise in the 70s and the 80s was a domestic oil and gas business in the Gulf of Mexico.
Right.
And
but specifically to the recycle ratio, right?
Yeah, the recycle ratio. Well, actually, a whole range of efficiencies. Our former colleague, Jeff Howard, had, as I recall, a 14-factor ranking mechanism for oil and gas companies, which I adopted. And I found that through the decade of the 80s, Freeport-McMoRan rated in the top 3 in all of the 14 categories for years running. And if you added the scores, the cumulative across 14 meant that Freeport-McMoRan was so far ahead of the rest of them that in a bad year they were ahead of their peers. And that led me to understand that some people are simply better at certain things in certain terrain. Freeport-McMoRan offshore in the Gulf of Mexico was that.
Right. Excellent. And anyone who's interested in that discussion, you can probably just search in the classroom for Freeport McMoRan, and that will come up in the classroom. Rick, unfortunately, we're out of time. It's a shorter session today. We have to get going. So I want to thank you for this Q&A session. I want to remind everyone about the boot camp coming up October 21st, rulesymposium.com/bootcamp. Rick, any parting thoughts for the classroom before we sign off?
Yeah, the parting thought is, first of all, to thank you and thank the participants for causing this to occur. But secondly, to remind the participants that the boot camps are meant to be used in conjunction with the Rule Classroom. The idea is that over time, we will develop a curriculum, a free curriculum in the classroom that will allow you to understand the techniques involved in evaluating investments. The boot camps are designed, first of all, with regards to the keynote, to give you the understanding of the sector that's necessary to frame the questions that you learned in the Rule Classroom for the exhibitors. Combining the two of those together on the exhibitors, of course, in the boot camp, but also on other companies in the sector, is what will make you a successful investor and speculator. But remember, it's an integrated process, both the boot camps and the classroom.
All right, Rick, if I don't talk to you or see you beforehand, look forward to seeing you in the studio.
I look forward to it as well.
Hope to see you there as well. Until then, take care. Thank you.
Thank you.